Welcome to Safe Option Strategies presentation of Technical Analysis Part 2. The following presentation is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. Any live trades discussed in this or any Safe Option Strategies class are additionally for education purposes only. There is no recommendation, implied or otherwise, to place these trades with real money. Okay, so in the previous class, if you're going in order, in the previous class, we talked about technical analysis, and we talked about, I'm not going to reread this definition of technical analysis. We talked primarily, if you remember, about the RSI, the MACD, the 5 and 20-day moving averages. We talked about levels of support and resistance, and we talked about volume. We also took some time to talk about the big picture of things, how to start with certain technical indicators and make them the focus of where your technical analysis begins, and then start to use other technical indicators to either help support what you're seeing with we talked about the big three being the RSI, the MACD, and the 5 and 20-day moving average. And then as you get those three painting a certain picture or telling you that a certain directional move is more likely than not, then you start looking at other indicators to help either rebut that or support it. You're either going to get confirmation through other indicators that what you're looking at has a good chance of happening, or what you're predicting has a good chance of happening, or you're going to see something that says, oh, I like that those three are kind of all pointing in the same direction, but I see a level of resistance that may be really difficult for this particular stock to move above. So even with these indicators pointing up in this direction, I don't know how confident I am the stock will move far enough. So to continue technical analysis, we're going to talk more about some of the other indicators that help support that or rebut it. But what I want to start doing is going through the process of setting up your charts to just make them as easy as possible to read. Now, I use stockcharts.com. That's my favorite charting, I don't know if I should call it software because it's actually a website, but it is my favorite charting website. You do not have to use stockcharts.com. There's no requirement to use stockcharts.com. Everything I show you, I'm going to take a few minutes to show you exactly how I set up stockcharts.com to give it the look that you see when we send out the Signal newsletter, when we put things on the website, when we're doing our live classes in the morning for the open trades that we're following. You know that every time we're doing that, I have a stock chart up on the screen that has a certain look to it. I'm going to show you exactly how I set up mine. You're welcome to do it the same way. You're welcome to do things a little bit different depending on what works best for you. Also, the information we're going to put on stockcharts.com can be put on any stock charting website or stock charting software that I'm aware of. So as we walk through setting up the 5 and 20-day moving average, when we walk through setting up RSI and MACD, those should be things that you can set up on any stock chart program or website that you use. Bar charts is probably my second favorite. On a rare occasion when stockcharts.com is not working, or they're having, and they're like every other company, they on a rare occasion may have a small website issue. I'll flip over to bar charts, and I can set up bar charts to look, barcharts.com. I can make it look very similar. On the trading platform that I use Charles Schwab's trading platform. I can look at charts on there, and I can set them up the very same way. So look beyond just the specifics of setting up stockcharts.com and make sure you're paying attention to just what information we're putting into that charting program so that you can apply it to any type of stock chart that you want to look at. I'm going to talk a little bit about some other moving averages. We focused in the previous class on the 5 and 20-day exponential moving average. I'm going to talk a little bit about some other moving averages that are important to pay attention to and to look at. I'm going to talk about the possibility of too much analysis. We'll talk about some other indicators. I'm not going to spend a lot of time on other indicators. There are dozens of technical indicators that you can overlay on any type of stock charting website or stock charting software. I'm not going to say that any of them are bad. I'm not going to say that you shouldn't use any of them. We'll talk about a couple of them, but I'm going to talk about the concept of too much analysis. We're going to introduce the next couple of classes. I'm going to talk a little bit about the importance of sentiment and earnings, and that's kind of just a little bit of a preview into the next couple of classes I'll do. So let's go ahead and move right into setting up stock charts. I'm going to show you a couple of screens that are screenshots that I took, and then we're going to switch over to an actual web browser, and we'll capture in this recording the actual web browser of how we set it up. So when you if you type into, whether it matters if you're using or Safari or Firefox or Internet Explorer, doesn't matter which one. If you type in charts.com, the screen that you should see. Now, I want to point out one thing on this screen. I have a small monthly paid subscription to stock charts. I think I pay $15 or $16 a month. It is not necessary to pay a subscription to stock charts. The only reason I pay a little bit each month to stock charts is so that when I'm teaching a class and I'm showing my students the screen of stockcharts.com, I don't have ads pop up, and I don't get the side over here. When I'm looking at a full-size web browser, I have a big empty space over here. I don't get that filling up with different ads, and sometimes ads that I think are distracting, and even on occasion, sometimes ads that I think are borderline inappropriate. That's the only reason I pay for it. Nothing that I'm going to show you on .com right now needs to be paid for. I want to make sure that's really clear. There is no need whatsoever that you purchase a subscription to stockcharts.com. So with that in mind, and let me hurry and I'm going to hurry and erase that. With that in mind, when you get to this spot, when you're forced to type in the ticker symbol for any stock, it really truly does not matter which stock ticker symbol you set this up with. It just needs to be a valid ticker symbol. Now, let me give you a couple of things. If you want your, I guess when I say it doesn't matter, keep in mind that whatever ticker symbol you put in here, it will become your default ticker symbol every time you go back to stock charts. After you've got this all set up one time, I'm going to show you a way to bookmark it so that you never have to go through this entire setup again. That's one of the advantages to that's why we're taking the time to do this, is so that you can do it once and never have to do it again. But whatever ticker symbol you put in here, it will become your default symbol going forward. So every time you go to stock charts, if you started out with Apple, if you started out with Boeing or Caterpillar, that's the chart you'll get each and every time, but you need only type in a different ticker symbol to get the same looking chart with that new stock. And the reason I'm going to point these out is because these are different on different websites. It's DJIA, Jones Industrial Average. That's all you need to do. DJIA will give you the starting ticker symbol of the Dow Jones. Now, when I type in DJIA, when the chart comes up, and I'll show you this in a second, when the chart comes up, I get something that looks kind of different. If I want the S&P 500, I have SPX, and then that would be my default. My default every time I start up stockcharts.com, my default would be the S&P 500 as the chart. If I want the I don't need to type in any symbols. You're going to see that these will come up, some of them, when they populate, but I don't need to type that in. I just need to type in DIA, COMP, or SPX, depending on which index I want. Okay, once I've done that, this is what it will look like in the default. And to me, this is a horrible looking chart for the type of analysis and for the way I analyze stocks. And if you're going to go through the whole Safe Option Strategies education, you need to know how I analyze stocks, because you need to know how I'm coming up with the picks that I'm making and how I'm coming up with the right timing for adjustments and so forth. So I'm not a big fan of candlesticks, and it defaults to candlesticks. I'm not a big fan of this color scheme. It's just this is just not a chart that I like. So let's switch over now to an actual, I'm going to go to Google Chrome. Now keep in mind, this will work with any browser. You do not have to do this on Google Chrome. You can do it on Firefox. You can do it on Safari. You can do it on Internet Explorer. The only thing I would encourage you is the way you bookmark a page works a little bit different with those different browsers. They all work similar, but Safari is probably the most different of the four. So make sure you know how to bookmark a page, because that's going to be important in just a minute. So here's the screen that we have, and what I'm going to do is simply scroll down this screen, and down here I've got chart attributes. I'm going to circle each one of these for you real quick. Down here I've got chart attributes, I've got overlays, and I've got indicators. Okay. The chart attributes are basically the information that is going to make up the actual design of the chart. And this is the way I like to set mine up. You can do it exactly like you do mine. You can make yours a little bit different. I usually start out with a 6-month chart. Now, I will sometimes look back farther and look at a 5-year chart, a 2-year chart, a 3-month chart, but I typically start out looking at, Jeff, I'm going to show you that exactly. Jeff asked the question, is there a fill page to make it look bigger? Yes, there is. I'll get to that part. So I'm going to start out changing this one to 6 months where it says range. Okay, that's the first thing I'm going to do. And hopefully, I know it's kind of small on your screen. Boy, I've got a screenshot of this once it's all filled out exactly the way I like it. And so you'll be able to pause this and take a look at that. Okay, so I've got 6 months here. I like to have either 15 or 20 extra bars, and the extra bars blank space over here on the far right. So today's information is right here on the far right. If I've got 15 extra bars, I'll have some additional space. So that's when I put extra bars, that's what I'm doing, is creating some space on the side. You can play with this. You can make it 15, you can make it 20. I wouldn't go a lot more than that, because it begins to distort the look of the chart. Okay, I get rid of candlesticks and I put in OHLC bars. All right, we talked a little bit about OHLC bars in the previous class. Now, this is what Jeff would size. You're going to have to experiment and play a little bit with this size, because most computer screens, most laptops are going to work really well if you change that to lamp. But if you've larger computer monitor, the dimensions of your computer monitor, you may want to make it 1024. You may need to shrink it down to 700. Play with this part a little bit until you get the chart filling out enough of your computer screen that you're sort of maximizing what you see on there. I'm going to set mine to landscape, because I will tell you, with most laptop computers, the majority of them, landscape tends to work really well and sort of set the dimensions automatically for your particular monitor size. So that's so far we've set the range at 6 months. We've added 20 extra bars. We've changed this to OHLC. We've changed this to landscape. I like my default color scheme blue-gray. That's the one that I use. I would encourage you to also play around with these, because you can see they actually have one specifically for someone who is color vision impaired. Now, as soon as you change the color scheme, this part of it will change, but nothing else has changed yet. We'll have to update and refresh. So play around with this color scheme part right here. Play try some different things there to see if that is most advantageous to you. That for the color vision impaired, it's for people that are basically colorblind. It creates a greater contrast between dark and light since it's more difficult to see colors. So I'm going to switch this back to blue-gray because that's the one I typically use, is the one that comes up blue-gray. And I'll be honest with you, I do that in part because it comes the closest to matching the entire color scheme of our company logo and the way I've kind of stuck with it. All right, moving along. I unchecked the box. You can see a couple of boxes now here, a couple of little bullet points below where it says blue-gray now. I check the box.
Log scales, and I like to unclick the one that says Y-axis labels. The Y-axis label is going to get rid of this information, and the log scales is going to get rid of some other information that to me just kind of clutters up the chart a little bit. So by getting rid of those, it's just a cleaner, smoother looking chart. Okay. Next, I'm going to go to my simple moving averages, and I'm going to change both of these to the exponential moving average. When I click this down arrow, I just have to move to the exponential moving average right here, and I want this one to be 5-day, and the other one will default at 20-day. And now I'm done. Now I'm finished. The RSI down here in the indicator section, the RSI and the MACD are already set up exactly the way I want them. So I'm going to clear all my marks off of here, and just one by one, I'm going to show you again just each thing that I changed. So we changed the predefined range to 6 months. We added 20 extra bars. We changed this to OHLC bars. We changed this to landscape. I chose the color scheme of blue-gray. You can play with that a little bit, and you may want to play with the landscape thing a little bit as well. I unchecked the box that said log scales, and I unchecked the box that said Y-axis labels. I changed these two overlays from simple moving average to exponential moving average, and I had to change one of them to 5 because they'll both automatically default at 20 when you change those. Okay. And then the RSI and the MACD indicators are the exact same. I mean, they're basically already set. Now, once I have done this, I can select any one of these places. I don't have to do them all. Any one of these places where it says update and has a little button that I can click on. I could even scroll to the very top to where it says update up here. Any one of the buttons that I press that says update will now set the chart according to what I just put in place. So I'm going to click on update now, and there's the chart that I want. Now I'm using a really big computer monitor. Remember, I set this at landscape, and I said for whatever size computer monitor you're using, you may want to play around with that a little bit. On the big computer monitor that I use to do these recordings, I happen to know that I could set this if I wanted to, and I'll just do this real quick for comparison's sake. I could set this if I wanted to at 1024, and it comes pretty close. That fills up a lot more of my screen. And earlier I said that I pay for a small subscription. All this white space over here would be filled with ads. And again, if those don't bother you, don't spend money monthly for a subscription for stockcharts.com if those ads there don't bother you. I just, for the sake of teaching classes and doing recordings like this, I don't like those ads there. Okay, so now we've got stock charts set up. Now this is really important right here. Right down below the chart, I'm just going to scroll this down a little bit on the screen. Right down below the chart, you've got this little link right here that says permalink. Okay. And I want you to look up at the top of the screen that I'm on, and I want you to notice this little URL address. Okay, this is the URL address for stockcharts.com. but this is not the URL address for everything that I just set up here. So if I just bookmark this right now, if I just selected my little option over here to create a bookmark, I'm going to go back to everything the way it was before I did this. And I'm going to have to go back through and change the predefined range and add the extra bars and change the size and change the color and change this to OH. I'll have to do all that again. Instead of doing all of that, I'm going to click right here where it says permalink. And I'm going to get this show up right here. And now I'm going to click right here where it says reload with ink. Now, before reload with link, before I do that, if you are uncertain, if you're uncertain how to create a bookmark on one of your web pages, highlight this right. Well, I got to turn off my pen. Hang on. Highlight this right here and copy it. And then find a notepad, find a Word document, whatever, and paste it somewhere else. Instead, I'm going to hit reload with link. And I want you to notice now that this is completely different. After this part right here, everything else right here was not there previously. Now it is. This is what I want to bookmark. This, if I create a bookmark now with this link right here, every time I go away from this page and I click on my bookmark, I will come back up with this ticker symbol that's in there right now. I've got the one for, remember I typed in DJIA, but this shows up $INDU. If you start typing in $INDU, it won't come up. For some weird reason, you have to type in DJIA. So mine will forever come up with the Dow Jones Industrial Average as my default, and it will come up with everything else set up the way. This is my 20 bars of extra space out here. This is my 5-day exponential moving average. I've got my RSI up here. I've got my MACD here, and I've got the colors that I like. So this is set up exactly the way I want it right now, and this is what I want to bookmark. Now, I've already got my bookmark here. Like I said, you need to know in whatever browser you're using, you need to know how to bookmark this. And if you're using Google Chrome, you're going to click on this little star right up here. You're going to click on this little star right here. And if you were to click on that star, it asks you where you want to put the bookmark, and I can drop this down. Oh, you didn't see the pop-up that came. I have a little pop-up that comes out, and it just asks me to confirm whether I want to put it on the bookmark bar or in some other folder, and I put it on the bookmark bar because that's what this is my bar of bookmarks right here. Okay. So this is how you set up stockcharts.com. And what's really nice is once it's set up like, in fact, let me do something else real quick for you. If I moved away from this page and went to CNBC, and then I could come right back to my bookmark. Let me circle it for you one more time real quick. I can come back to my bookmark now and click it. And it will take me right to that chart the way I had it previously set up. And there, that chart looks exactly the way I want it to look. Now, without changing anything else, without having to go through that whole process again, I can put any ticker symbol in here I want. And the look of my chart stays the same. And that's the way I like to do it. Okay. Now we're going to shift back over to here. And I'm going to leave it on this screen for just a moment. If you need to pause or if you need to take a screenshot of this or do something, this has everything the way you want it to be set up. So if you need to refer to this or use this as a reference, every single one of these things that we just set up, you can mirror it to look exactly like this. And that'll be easier for you going forward. And this is our product. and I put some, just as a reminder as you're going through. Actually, the reason I have this on here is for people that want to print a PDF and a copy of this. And some people like to print it and have it in paper. All right. Now, let's talk about a couple of other important moving averages. We start out with the 5 and 20-day moving average. The reason I set my stock chart with the 5 and 20-day moving average is because the 5 and 20-day exponential moving average are used more often by a greater percentage of investors, so they have more of a tendency to become a self-fulfilling prophecy. The reason we, and this is just a little bit of a recap going back to the previous class, the reason we use the RSI, the 5 and 20-day moving averages, and the MACD as our three primary go-to technical indicators is because a larger percentage of traders and investors use those three things, and they therefore have that ability to become a self-fulfilling prophecy. Now, a couple of other really good moving averages to keep an eye on, and again, you're using this as a way to confirm other things that you want to look at. You're using this to either rebut or confirm something that you're seeing on the 5 and 20 moving averages. And what they are, the next two that I'm going to talk about are the 50-day simple moving average and the 200-day simple moving average. Now, mostly, not exclusively, but mostly, the 200-day and the 50-day simple moving averages are used to help confirm levels of support and levels of resistance. That's not the only thing they're used for, that's what they're mostly used for. Remember, if you remember from the previous class, we talked about levels of support and resistance, and we talked very specifically about sometimes it's hard to draw exactly where that support and resistance is. You see levels on your screen when you're looking at a chart like, well, I see that it looks like a couple of times here and here this got tested as resistance. And I could maybe make a case that over here it was tested as a little bit of support, so that sort of helps me draw a line right here along this particular line. I can see a level of support right around here. And what I'm doing here is right now, the 50-day simple moving average happens to be right in that same spot where I'm thinking there's maybe support, and that helps me give a confirmation that I'm reading this correctly, and that's where support is at. I'm going to switch back over to our Google Chrome where we have our stock charts real quick. So if I've got stock charts up and I'm looking at this and saying, you know, let's go back to one of our indexes. Let's go back to the NASDAQ index. We'll put in comp right there. I'm looking at this and I'm saying, all right, based on my understanding of levels of support and resistance, I see that maybe the NASDAQ is stalling right around here, because this was a level of resistance. It tried to push above, it fell back down a little bit, and then it was able to push through before it hit an all-time high back in February of this year. Then we had, of course, the big pandemic-related crash of 2020, and now it's coming back up. And right when it got back up to where it tested some resistance here, it tested some resistance here. But that's kind of weak resistance. I can only point to one spot only where it looked like that tested a resistance level going up. To me, that's kind of weak resistance. So to help give me some confirmation if I'm reading this correctly, I'm going to go down here and I'm going to change this from the exponential to the simple moving average. And I'm 50, and I'm going to just from the exponential to the simple moving average and put in the 200. And then I'm going to hit update. Everything else will stay the same on my charts. And as long as I don't bookmark this now, then I'll still look at my 5 and 20-day moving averages first. But here's something that's interesting. I'm going to point out two things that are interesting. Number one, going back here to my 50-day moving average, that's not too far away from where I was looking at resistance right here. And right back here, the 50-day moving average then flattened and came down and went into this sell-off right here. And that's not too far away. I'm looking at that and I'm saying, okay, I'm close. I'm not too far off the mark thinking that's a level of resistance. But here's the other thing I'm looking at. I've got the 50-day and the 200-day simple moving averages right on the verge of crossing over, and it would be a crossover back to the upside. And I can look at this and say, you know what? Until that crosses to the upside, I'm probably not going much higher than I am right here. And that, in my mind, that bolsters just a little bit the notion that we're sitting in resistance. Now, I don't need all of that information to look at this and say, this feels like a level of resistance right here, 9,400. It just feels like a level of resistance. But if I'm a little bit unsure, I add these simple moving averages in and say, you know what? I'm close just by looking at this and close to crossing over. Maybe I want to wait and see if this gets a crossover before I'm bullish for another leg up on the NASDAQ. Obviously, it's been bullish for a while. There's no question about that. But maybe more trade NASDAQ related. I wait and see if I can crack that. I wait and see. So you get some confirming information there. And that's what I like to use the 50 and the 200-day simple moving averages for. When you're listening to, if you're watching the news in the morning, if you're listening to the financial news, the talking heads and TV, you'll hear a specific reference from time to time to the index just crossed over the 200-day moving average, or it just average is selling off, but it hasn't yet dropped below the 50-day moving average. These are probably the next two most common moving averages that are used in technical analysis by a large number of traders and a large number of investors, but they're used more to mark levels of support and resistance than they are used for the technical crossover that comes on them. Here we've got the this is the reason why. Here we've got the technical crossover. Let me erase my other marks here. Here we've got the technical crossover to the downside, suggesting bearish movement, but that came when we were almost at our lowest point. This is not an indicator. This is not an indicator of the fact that we're moving bearish. We started moving bearish back here. The 5 and 20-day moving averages would have picked that up. The 50 and 200-day moving averages are crossing over when we're almost at the very bottom. So we don't use them as much for the crossovers. Not that we don't ignore that, but we use them much more for the levels of support and resistance. Now let's talk about some other moving averages, but I'm going to do this in the context of the danger of too much analysis. When we moved away from this screen and we were on a live web browser, these pop-up did not come up. When I was setting up these charts, when I switched from the simple moving average to the exponential moving average, you didn't see the box. We've got Bollinger Bands, we've got horizontal lines, we've got Ikimoku clouds, Keltner channels, SMA envelopes, EMA envelopes, parabolic SAR, zigzag retrace. Now you can play around with these, and what any of these mean, you can look up the definitions of them on investopedia.com. I think that's a great website to look up definitions of what different things mean. And you can set these up to show on your chart. And we'll jump back over to the web browser in a minute, and we'll play around with a couple of these just kind of for fun more than anything else. But then I had to shrink this down on the screen just to fit it all on. You've got all of these. You've got accumulation distribution lines. You've got Arun oscillators. You've got average true range. You've got Bollinger percent. You've got Chopak curve, force index. You've got all this different stuff. Do you realize that when you start combining, you can put up to 6 of these different things on your stock charts? Do you realize when you have this many to choose from and you have the possibility of any combination of 6 of those, do you realize how many different combinations you could come up with? It is in the hundreds of thousands, maybe more. It is in the hundreds of thousands of different combination of indicators that you can put in a stock chart. And there becomes a real danger, especially for the engineers. And I'm not picking on the engineers, but an engineer's mind, and accountants fit into this category as well. Their minds are wired to where they love information. They love mathematics. That is a really good thing, in my opinion, up to a point. Don't get paralyzed by overanalyzing all the different indicators that are out there. Analysis, or some people say paralysis by analysis, is a real thing. It is absolutely a real thing. I have had conversations with people over the years that are looking for 15 or 20 different things to line up exactly the right way at the same time before they'll ever place a trade, because they've gone into some deep study of technical analysis and chart reading. They want their candlesticks to tell them the same picture as a price performance graph, and they want that to be the same as a VWAP, and they want it to fit within the standard deviation that they would see, and they want all of this to fit nicely within an Ikimoku cloud. And they're getting paralyzed, and they'll never make a move. They'll never open a trade. And if they ever do open a trade, they'll never know when to get out of it, or they'll panic and get out of it too early. And this is a very real thing, and don't get caught up in that trap. From time to time, I don't use it a lot, but from time to time, let me go back over here to our stock chart that we set up, and I'll show you a couple that I use from time to time. Every now and then, I like to include Bollinger Bands in here. Bollinger Bands that's these 2 lines that are at the outside. So the question just came up, how do you avoid being paralyzed by the analysis? I'm going to share with you, and please don't anyone be offended by this. I'm going to share with you an acronym that I know you have heard multiple times in your life. Ever heard of this acronym? When you put this last one on here, most people put the word stupid right there and it becomes offensive. You can really just focus on this part right here. This acronym is for keep it simple. Can't see my eye on there because I hid it behind that other line. Keep it simple. The way to avoid being paralyzed by overanalyzing something is stick to what works and stick to what is proven most of the time. Earlier, a question came up, and I knew I would talk about it at some point, so I skipped it when the question came in. But earlier, a question got typed in, why do you use the 5 and 20-day moving average? You know why? Because 90% of all the people that trade stocks and options look at the 5 and 20-day moving average. And what do you think the majority of them do when the 5 and 20-day moving averages cross each other to the upside or downside? Now I still have the 50 and the 200-day simple moving average in here. I'm going to change these real quick. I'm going to go back to my exponential moving averages so that what I'm saying is not completely lost. If I'm aware that historically more people look at the 5 and 20-day moving average than anything else when they're deciding if a trend is changing, guess what's going to happen? That's when people are going to start selling when those cross over. That's when more people are going to start buying when those cross over back to the upside. Why do I use the RSI instead of some? There's about 6 or 8 different variations of RSI, and stochastics is very similar In fact, honestly, you could replace stochastics with RSI, and I think it gives you close enough to the same information that it wouldn't be a lot different in your results. I use the RSI because 75 to 80% of all investors that actively trade, including your brokers and your hedge fund managers, they use the RSI. I'll bet it's close to 100% of investors that have any training at all on technical analysis look at the MACD. That's probably the most common used of these three. So how do you avoid being paralyzed by analysis? Start out with the RSI, the MACD, the 5 and 20-day moving average. And if they give you a very, very clear-cut picture of what's happening, then start looking at levels of resistance. Start looking at levels of support. Start looking at volume. Is there volume driving what's going on? Are the 50 and 200-day simple moving averages helping to build my confidence that I'm accurately picking a level of support or resistance? Is there news that's driving this? Go back to the couple of classes ago when we did a class on fundamental analysis. Is there news that's driving this? Is there a fundamental weakness in the stock and the company itself that's driving this movement? And then if you'll keep it into a narrow range like that, then on occasions, it's not a horrible thing to look at something like a Chaikin oscillator. Okay, I just replaced my RSI with a Chaikin oscillator. You know what? It has a midpoint, and I'm looking for times when it crosses that midpoint to the upside or downside. Okay, from time, and I don't ever use the Chaikin oscillator, so I'm kind of playing around here. There's one that a lot of people like, which is accumulation distribution line. This is an indicator that allegedly shows where big money is going. When this thing is moving up, there's more activity with big money, meaning brokers and block orders of thousands and hundreds of thousands and millions of shares at a time. And this is an indicator that big money was starting to bail out. And then big money was kind of neutral through here. And then you can see right around the time this thing really started getting legs from right here up, big money was allegedly flowing back in. Accumulation distribution. Okay, there's a lot of these you can play with. There's, let me see if I can find it on here. There's Fibonacci retracements. If I can find it. I'm not seeing it on here. Fibonacci retracements are, it shows you standard deviations away from the average price. And you'll hear people refer once in a while to standard deviations. How many standard deviations are we away from what the most recent high was or the most recent low? I thought Fibonacci charts were on here and I'm not even seeing them. There's Kaufman's moving average. And that's just a slightly different formula. You can see it matches the Kaufman's moving average. If you can see the colors very well, it's kind of hard with the red and green there, but Kaufman's moving average is following pretty close to the 20-day moving average on this one. So don't be afraid. Here's where some balance comes into play. Don't be afraid to look at and study some of these other things. Don't be afraid to check these things out. If you've got a definition of one of these, or if you're curious about it and you look up a definition, there's nothing wrong with doing that. Nothing wrong with doing that at all. Just be careful. Just don't get overly bogged down in too many things. And if you're starting to see too many things doing too many different things, come back to the basics. Come back and keep it simple. RSI. I'm going to get rid of this. RSI, 5 and 20-day moving average. MACD, supporting volume, levels of support and resistance, news that may be moving things. Circle back around to your fundamental analysis, and you'll be right way more often than you're wrong. Now, two other things that are important as part of your overall analysis. These might fit a little bit more into fundamental analysis, but there are some technical things that are important as well. So we have two upcoming classes on sentiment, how to measure and gauge market sentiment, near term and long term, on the markets overall and on a stock overall. And then the importance of and what to look for and what to pay closest attention to in earnings reports. You got to be aware of what other investors are thinking. There is a herd mentality in the market. There's very much a herd mentality in the market. So you have to be aware of what other investors are thinking. You never want to lose track of when the next earnings report is. And with earnings, we'll talk about some other events like dividend dates, when dividends are announced, when dividends, what's called an ex-dividend date. There are events that take place with a company. We'll cover more than just the earnings event, but there are events that are scheduled and take place periodically with companies that have the ability to drastically change the direction of the stock or move it strong in the direction that's already going, giving it a boost one direction or another. So we'll talk about those, and those are the next two upcoming classes. In summary, don't forget, this is a repeat of what was in technical analysis part 1. No technical indicator by itself is perfect. Educated guesses are still guesses. All of this technical information that we're looking at is to help us make the most educated guess we can possibly make. Don't allow yourself to be paralyzed with too much information. Remember that acronym. Remember that acronym. Keep it simple. You don't have to put the second S on there if you don't want to. Keep it simple. Once you've analyzed something and you have some level of confidence with your analysis, make a decision and stick with it. As we get deeper into the core of this education, we're going to get into strategies and we're going to get into adjustments. And the reason you make a decision and stick with your decision is because your adjustment strategy is for those times when you're wrong. Don't waffle on the decisions that you make. Make a decision, stick with it, and then if something changes, know that you have your backup parachute or your safety net, whatever you want to call it. Your adjustment strategy is there to keep you from crashing. That wraps up our class on technical analysis part 2. Thanks, everybody. Bye-bye.